Hey everyone, welcome back for another deep dive. We're tackling the markets today, and let me tell you, there's a lot to unpack.
Yeah, no kidding. It's a real head scratcher out there.
We've got tech stocks seemingly defying gravity, those bond yields throwing a wrench in things.
And earnings season, talk about a roller coaster.
Exactly.
Yeah.
So let's start with this tech rally, because it's been wild. The markets take a dip early on, everyone's nervous, and then bam.
Like a superhero landing, it's the mega caps to the rescue.
Meta, Amazon, Microsoft, they all swooped in to save the day. And then there's NVIDIA hitting an all-time high. With all the uncertainty out there, it's kind of mind-blowing, you know?
It really makes you wonder what's fueling this tech dominance. Is it sustainable, or are we putting too much faith in a few big players?
Right. Like, is this healthy, or are we setting ourselves up for a fall? What do you think?
Well, one factor we can't ignore is the Fed. Remember, everyone's expecting a potential rate cut next month.
That's true. The rumor mill's been churning.
And that anticipation, it kind of creates this risk-on mentality. Investors see a softer landing on the horizon, so they're more willing to gamble on riskier assets, like our beloved tech stocks.
So it's like a Fed safety net rally.
In a way, yeah. But, and this is a big but, we can't forget about those climbing yields.
Yeah, the 10-year Treasury yields went above 4.2% today, highest since July. Usually that's a big flashing warning sign.
Exactly. Higher yields usually mean investors are nervous, shifting to those safer assets like bonds.
So why is the S&P still up for the month? It's like we're living in a parallel universe or something.
It seems counterintuitive, but there are a few things at play here. Remember the Fed's potential rate cut we talked about?
Right.
Well, that plays a role here, too. It's not just about domestic investors. The strong U.S. dollar is attracting international investors like crazy. They're hungry for better returns, so they're buying up U.S. treasuries, driving those yields up. It's like a financial balancing act.
A balancing act on a tightrope, maybe? So should investors be hitting the panic button yet? Or is this yield situation something we can ride out for a while?
I wouldn't hit the panic button just yet, but it's smart to stay vigilant. Keep an eye on that bond market volatility. It's important.
No, I bet it is. What's it looking like these days?
Well, to give you an idea, it hit a 10-month high today.
Whoa, okay. That's not reassuring.
And historically speaking, that level of volatility often comes right before the stock market takes a dip. It's like those bond investors, when they get nervous, those ripples, they always seem to reach the shores of the stock market eventually.
Duly noted, forewarned is forearmed, as they say. Okay, let's shift gears from those volatile yields to another roller coaster earnings season. We saw some real head scratchers today, didn't we?
You said it.
Take General Motors, for instance. Their stock shoots up almost 10%, but they're still dealing with those struggles in China.
It's a classic case of exceeding expectations, and I mean really blowing them out of the water.
They weren't just a little bit better than expected.
Not even close. They smashed those earnings forecasts, raised their full-year forecast, the whole 9 yards, and they signal that their core business is still going strong, even with those challenges in specific markets. In this environment, that's music to investors' ears.
It's a good reminder that sometimes it's not just about the numbers themselves, but the story behind them.
Right. Absolutely.
Now, on the flip side, we had Lockheed Martin taking a tumble today, down over 6%, and they still beat earnings expectations. What happened there?
Lockheed Martin. See, their story highlights a crucial point. Revenue is king, especially now. Yeah, they might have beat earnings per share, but their revenue fell short of expectations. And in this market, investors are laser-focused on top-line growth. So when a company, even a giant like Lockheed Martin, stumbles in that area, the market doesn't hesitate to react.
So exceeding expectations is key, and revenue growth is king.
Got it. Now, for our international listeners, or anyone who likes seeing how the rest of the world's doing, Philip Morris International had a heck of a day.
Oh yeah, they were on fire, surging after posting some really strong earnings. It's kind of wild to see a consumer staples company thriving in this environment. What's your take on that?
Well, it tells us a couple of things. Firstly, even with all the economic uncertainty right now, certain consumer staples are proving to be pretty resilient. People are still buying their products, which means there's a level of predictability there that investors find comforting. And secondly, Philip Morris has been shifting its focus towards those smoke-free products, and that seems to be paying off big time. They saw a 17% jump in that segment this quarter.
Wow, 17%. That's huge.
It goes to show that even in tough times, companies that adapt to changing consumer preferences can still pull off some pretty impressive growth.
It's a good reminder that even with all the uncertainty out there, companies are still innovating and finding their footing. But before we move on to the broader market trends, we got to address the elephant in the room, don't we?
Ah, you're talking about Tesla, right?
Got to talk about Tesla. Their earnings report drops tomorrow, and the anticipation is palpable. Everyone's holding their breath on this one. What are investors watching for with this one? What's got everyone so on edge?
Well, Tesla, they always keep us on our tongues, don't they? And this time is no different. I think investors are laser focused on three main things. Delivery numbers, obviously, because that's huge for them. Earnings per share, always got to watch those. And then, of course, there's the Elon factor.
The Elon factor, right? Because what Elon Musk says or does, it can move markets.
Oh, absolutely. Remember back in July, their deliveries fell a bit short and their EPS missed and the market freaked out a little.
A little freak out, just a tad. So Tesla's definitely one to watch. Okay, so beyond earnings, what else should investors be keeping on their radar this week?
Well, housing data is always a big one, and we're expecting both existing and new home sales data this week.
Right, because those numbers give us a peek into the health of the housing market, which, let's be honest, is always a good indicator of how the overall economy is doing.
Exactly. Plus, let's not forget about interest rates. They've been all over the place lately, and that has a direct impact on mortgage rates. So these housing reports, they'll be under a microscope for sure. Investors will be looking for any hints about the Fed's next move.
It's like a game of market chess out there.
Mm-hmm.
Okay, shifting our focus internationally for a moment, for all our globally minded listeners, what's happening beyond U.S. borders these days? The Bank of Canada's meeting tomorrow, right? And there's talk of rate cuts. How might that impact us here in the U.S.?
Yeah, the Bank of Canada, they're widely expected to cut rates for the fourth time in a row, which is a big deal. It really points to a global easing cycle that's starting to take shape. Central banks around the world, they're easing up on those rate hikes, and some are even switching gears completely.
So we're still wrestling with inflation here in the U.S., but other countries are changing their tune. Interesting. What does that mean for the U.S. dollar?
Well, here's the thing. When other countries lower their rates, it can actually make the US dollar stronger.
Really? Why is that?
It's because investors are drawn to those higher yields offered by US Treasuries. But, and this is important, a strong dollar isn't always a good thing.
Okay, yeah, there are always two sides to the coin.
Exactly. It can actually hurt US companies that do a lot of business overseas, make our exports more expensive, and ultimately that can put a damper on economic growth. It's all connected.
It's like a giant interconnected web. Speaking of interconnected webs, oil prices have been on a bit of a roller coaster ride lately, haven't they? All those geopolitical tensions in the Middle East, it's enough to make anyone nervous. How are those tensions playing out in the energy market right now?
Yeah, the Middle East always adds a layer of complexity to the oil market, that's for sure. We saw crude oil prices rebound a bit from that dip below $70 a barrel last week, but they're still nowhere near those highs we saw recently.
Oil prices have been all over the map lately.
Part of that is because demand from China hasn't been as strong as some folks expected. But here's the thing. Any escalation in those geopolitical tensions, and those prices could shoot right back up again. It's a volatile situation, to say the least.
Okay, so let's recap for a second, because we've covered a lot of ground here. We've got tech stocks on a tear, bond yields throwing a wrench in things, earnings season keeping everyone guessing, a potential global easing cycle taking shape, a strong U.S. dollar, and those ever-present geopolitical tensions in the Middle East.
It's a lot to digest, for sure.
It's a lot to digest. So before we move on to our final takeaways, I want to circle back to something you mentioned earlier, the importance of exceeding expectations in this market. We've seen companies like General Motors get rewarded for blowing those forecasts out of the water, while others like Lockheed Martin get penalized for simply meeting them. It really feels like the bar has been raised, wouldn't you say?
Yeah, I think that's a fair assessment. The name of the game right now is resilience. Investors are looking for companies that can not only handle all this uncertainty, but actually thrive in it. They want to see growth. They want to see companies beating those expectations. That's what signals strength in this market.
Resilience, adaptability, those seem to be the key ingredients for success these days. So with all these factors swirling around, what's your biggest takeaway for our listeners? What should they be focusing on as we navigate these, well, let's be honest, kind of choppy waters?
I think the most important thing is to look beyond the headlines. It's easy to get caught up in the hype, especially with tech stocks grabbing all the attention lately. But at the end of the day, it's about understanding the bigger picture.
Seeing the whole board, not just one piece.
Exactly. You got to look at interest rates, global economic trends, how individual companies are performing. All of it matters. Don't get swept up in the hype, do your research, and make sure your investment strategy aligns with your long-term goals.
Wise words. Well, folks, there you have it. We've journeyed through tech rallies, volatile yields, surprising earnings reports, and even touched upon those global influences shaping the market. It's been quite a ride.
It has. Never a dull moment.
A huge thank you to you for joining us today and sharing your expertise. We always appreciate your insights.
My pleasure. As always, it's always great to break down these market dynamics with you.
And to all our listeners, thank you for diving in with us. We'll be back next time with another deep dive into the fascinating world of the markets. Until then, happy investing, everyone.